Thanks for joining David, Kevin, and myself for the market update for the month of February. As always, we hope you and your families are doing absolutely fantastic. We had a blistering start in January. Things cooled off a little bit in February. The S&P 500 was off 2.4%, as well as the TSX off the same 2.4%. The international market was off 2.1%, and even the bond index was slightly off. I'm going to pass this now over to David and Kevin, and again, hope you guys are doing great.
Kevin, what was driving the markets in February?
Well, after a very optimistic start to the year in January, investor sentiment did deteriorate a bit in February. The current environment is a confusing one. On one hand, the economy continues to be very strong, unemployment is at near record lows, and consumer spending remains elevated. However, the strong economy is inflationary. If virtually everyone is employed, that means those people have the funds to continue paying their bills and in general just continue spending money, which is not going to bring inflation down very quickly. Businesses still need to hire employees, which means there's still a need for them to offer competitive wages in order to entice applicants to apply for those jobs, which is working directly against the central bank as they try to bring inflation back down to their 2% target. Now, inflation did peak in June of 2022 at around 9%, and since then, year over year, inflation has gradually come down and currently sits at about 6%. But in February, inflation data did not drop by as much as was the consensus prediction by the markets, and so it was viewed negatively by the markets. Risk assets sold off a bit on the expectation that interest rates may need to peak at closer to 6% in the US compared to previous expectations of closer to 5.25% to 5.5% in January. There's also been talks by central bankers in Canada and the US that these interest rates may need to remain elevated well into 2024 in order to get inflation back to target. And then after that, they could consider any rate decreases. With all that being said, is there any advice we can give some restless investors at this point?
Yeah, I think so, Kevin. Obviously, we're all very consumed with the inflationary story. That's pretty much the only question that markets are really concerned with wrestling with right now. We know from past inflationary periods, inflation doesn't necessarily go from an elevated level back down to that 2% range that is deemed acceptable overnight. It does take time, and sometimes it happens in fits and starts too. The data may look good for 6 months, it's kind of dropping nicely, and then it stagnates or even maybe goes up a tiny bit before it starts to drop again. In the moment, the markets tend to sort of overanalyze and overinterpret every little morsel of economic data that comes out, particularly as it relates to inflation. That's not new. That's just what the market does. It's going to, obsess over every little piece of data and try and figure out what that means for short-term trading and market pricing. But I think for investors, it's important to remember, it does take a little bit of time for these things to unfold. Eventually, inflation will get back down towards its target. It's just a matter of when, not if. And then in the interim, it's important to, take a look at your own portfolios and remember why you own certain things. So obviously, in a diversified portfolio, you're going to own some stocks, you're going to own some bonds, and you may be carrying some cash or shorter term investments as well. And so in this environment, we obviously own stocks for their long-term capital appreciation. They may pay dividends, which grow over time as well. Basically, we're attracted to owning stocks for their long-term growth potential. And anytime somebody doesn't need money in their portfolio for more than 7 years, that's when we might encourage someone to consider allocating money in their portfolio to stocks for the long-term growth potential and to retain their purchasing power as it relates to inflation. We also, in a diversified portfolio, own bonds. Typically, in a market where stock markets are dropping, bonds tend to protect a little bit. They're not typically correlated to the stock markets. In fact, historically, they've shown negative correlation. Now, in 2022, unfortunately, bonds did not hold up that end of the bargain. They were down at the same time that the stock markets were. However, going forward, interest rates are quite a bit higher than they were a year ago, and now bonds are showing some pretty attractive valuations, and should, if we get a recession or we get that hard landing, economically speaking, bonds should perform quite well. And then of course you may own cash or GICs in your portfolio for shorter term needs. Anytime you need money within the next 2 years, we typically recommend holding some cash or some short-term GICs. And finally, after many, many years, cash and GICs are finally paying a decent interest rate. You know, for cash, you can get a little over 4% now. And for GICs, if you lock in for 1 or 2 years, you're almost, you're around 5% for those terms. So it's important at this time, I think, to keep a level head, you know, not panic, recognize why you own certain things and what the pros and cons of those different asset classes are. And if you have any questions about how your portfolio's asset allocation is set up, just don't hesitate to reach out to Harry, Kevin, or myself.
Have a great day.